Welcome to ECN Trade Daily Video. Before we begin, it should be noted that any advice is of a general nature only and that your personal circumstances have not been taken into consideration.
Hello everyone, my name is Rob Clayton and thank you very much for joining me. To begin with, the Australian dollar lost some ground on Friday with the mild bearish price action ended the New York session close to the lower side of the range after posting a low of 72.36. Earlier in the session though, the Aussie did rally up to a high of 72.83. Surprisingly, the market at present seems unfazed to the lack of progress in trade talks between the US and China. Nevertheless, China markets will be closed at the beginning of the week amid New Year's celebrations. Looking ahead, though, I do expect to see any advances towards 72.75 to 73.2040 as a potential opportunity to shorten the market. I believe that from a technical point we are failing and therefore should fall back towards the bottom side of the range of 72.15 or to 71.65 to 75 is where I see the objective. No doubt the market will be looking forward to the RBA rate decision tomorrow and see what the RBA has to say in the statement. Moving on to the euro, well, since the rejection from that 115.15, the euro has struggled to maintain any gains. Also reported last week that Italy has officially slipped into a recession and Europe as a whole is essentially at the economic standstill, which raises the world on the verge of a significant slowdown. The timing could not be worse. After the performance of the Italian economy reported on Thursday is likely to aggravate relationships, that is, between the European Commission and Italy's populist government, which has pursued spending policies widely regarded as irresponsible. Also on Friday, the hiring boom in January was relatively strong after the release of the non-farm payrolls smashed through the estimate of 165,000 to a high of 304,000. It was one of the most impressive numbers seen and marks January 100th month in a row of positive job creation, by far the longest streak on record. The Labour Department said that the government shutdown had no disconcerting impacts on the hiring and wages, but did not contribute to the uptick in unemployment. The unemployment rate did nudge up slightly from 3.9 to 4%, a level last seen in June. Along with this, a likely effect in the shutdown, according to the department, may be the cause of the slight uptick. The job creation saw muted wage growth, though, with the average hourly earnings rising just 3% on a month, or 0.1%, well below the expectations of 0.3%. Looking ahead, though, from the rejection of 115.15, I do ascertain the fact that the market could actually break down further, but it needs to take out the level of 114.35 to expose the region of 112.55.75 and reassess from there. Any advances should still find rejection from the 115 region. Well, since the rebound in dollar yen, the market has actually staged a significant move back to the upside. And as you can see from the 108.45, looks back towards the level of 110. I would say 110.2025 with the immediate level 109.70. Little to come out from the Brexit over the last few days, but nevertheless the market is breaking down. It needs to take out this level of 130.2040 to give further indication that the pound can actually break down, but from a technical point you can see here is getting a little bit concerning and therefore could see a further move sub 130.20 to the region of 128.40.60, with the resistance at this stage likely to be contained around 131.35 and firmer above at 132. Gold finally backs away from its recent topside challenge of 1,324 to 26, an 8-month high. From the pullback, could see a move now towards the region. I would feel that around 1,309 to 11 before any turnaround. From a technical point, we are easing out of an overbought situation. Looking at oil, well, as you can see, the market at this stage is still showing bullish momentum after surging nearly 3% on Friday and taking out the level of $55. At this moment in time, I'm looking for further rise up to 57 to maybe 58 as a target, with any pullback still like to be shallow, with support seen at 54, 55. Looking at the equity market, if we look at the S&P, you can see here that there is a cap roughly around 2,718 to 20. It is assessed that where the market stands at the moment, we are breaking down slightly. So therefore could see a move towards 2,702, or with a base temporarily at 2,696. And looking at the Nasdaq, at this stage, again, there is a cap coming in roughly around 6,925 to 35. It is assessed, though, with Amazon's bit of a shake-up and scaring the market, that it's off 20% and off its 52-week high, could put further implications on the Nasdaq, and therefore see a turnaround back towards the downside, giving us 6,869 to 6,834 target. Well, that wraps up for today. Thank you very much for joining me, and as always, look out for an intraday report, and I hope you enjoy the great start to the new week.